students who need playback. All right, we'll get started. Good morning. We're going to be on Module 9, Lesson 5. This will be our first lesson for fourth quarter. So we just wrapped up third quarter. We're going to be moving into fourth quarter. And again, you can check your final grades in Infinite Campus. I got those posted. If you have any questions, let me know. Or if you think something doesn't look right or anything like that, let me know. Because I can make adjustments till Friday. The grading thing closes Friday morning. So if you think something's off or if you have a question on something, let me know and stuff, because I can still go in and edit now, but after Friday afternoon, then it's a whole big thing to edit stuff. So and everything. So all right, so we're going to be looking at fiscal and monetary policy. All right, and so today we're going to concentrate on kind of monetary policy, what that is. We'll get our course arc notebook going, and then tomorrow we'll kind of do the second half. We're going to do a Nearpod today and stuff. So have your phone ready to participate, all right, so that you can participate in the Nearpod. So try to get a little bit more interactive. If you're just joining, welcome. We're just getting started. Just want to let you know your third quarter grades are posted in IC, Infinite Campus. If you have any questions, let me know. If anything doesn't look right, let me know, because I can go in and edit till Friday, and then after that, it's a whole big thing. And tomorrow, we're going to work ahead. No, this isn't due this week because we have spring break coming up. So this will be due the Tuesday after we come back. But that Monday, the 20th, I think this is due the 21st. The Monday when we come back, the 20th, and stuff, we'll start 9.6. So my goal is to get ahead a little bit. And we did that before, and it really does help, when we did first to second quarter, and it helps just kind of take off some of the stress and kind of keep an easy pacing. Eventually, it's not so easy pacing, but it does help out. Okay. All right, so you're going to want to get your Canvas open. So what standards are we going to be looking at? We'll be looking at the influence of the market, how inflation, that's something we're all dealing with right now, right? We have historic inflation right now, 40-year high. So this is on topic of what we're kind of living through. And how does the government impact the economy? So when they put more money into the economy, when they lower interest rates, what does that do? When they take money away, when they raise interest rates, what does that do to our economy? And stuff, and it definitely has influence. And usually when they do something, it's trying to correct either an economy that's a little too happy. When I say happy, it's going a little, we have to kind of rein it in to bring in stability. Or when we're having a really hard time like we are right now, what do they do to try to bring us back to that kind of moderate, even, consistency level? How is the federal budget determined? So we'll talk about those steps, stuff, and evaluating that, and how the policies that the government, how does it impact our economy? Okay, because there are two separate entities, but the government is very much involved in our economy. All right, so for our bell ringer, can any of you take a guess? What is our current national debt? Anybody guess what is the current national debt? You can unmute. Give me a number. Billions? Not even close. Trillions. Yes. Trillions. More. Oh, Vanna, we're getting close. Yeah, it's oh, okay, not that high. Not that high, Chris. Come back. It's closer to 30. Yeah, it's a lot. Okay, it's a lot. Okay, you guys ready? Okay, so this link I have, it shows literally a live clock of what our debt is. And then you'll notice on there that they'll even show if we were to break up the national debt between all the citizens, how much each of us would owe. And it's eye-opening. It's tough. I think it's a little depressing, but here you go. All right, let it load. It's taking a minute. Okay, we are at $31.6 trillion in debt. So per person, so if you broke it up into every single citizen, which our current population is 334 million. Okay, so if every single person, no matter what their age, if we broke up this debt into every single person, each of us would owe $94,000. Now, if you actually count people who are taxpayers, because I think a lot of the population is, I know this is eye-opening. Okay, so when people say they're like, I want this, I want that, the government, needs to provide free this. It's not free. This is the impact that it has. Everything costs money, and it comes back on us because the government gets their money from us and then they spend it. And as you can see, they spend more than they're taking in. So they're not the example of good budgeting. So don't look to the government for good budgeting. All right. So if we only broke up the debt into taxpayers, that would be $246,000 each. I mean, that is so much money. If I add up what I make in a year, like how many years it would take me to pay that off, I mean, years and years and years and years, like insane. All right. So it kind of gives you a little bit of a perspective, like, and this just keeps going up. So if we go back to, is this surprising? Yeah, exactly. I don't want to pay 96, but this is where, and we're not going to blame a party because both parties spend, okay? Republicans and Democrats, they both spend. Some more than others, but they both spend, okay? They're both responsible for this debt. In fact, the last time we actually had a balanced budget was in the mid 90s when Bill Clinton was president, who was a Democrat, and Newt Gingrich was Speaker of the House, a Republican, and they actually, oh, here's a nasty word, compromised. And they, when I say balance the budget, that means that they spent what they took in. So it's been almost 30 years since we balanced the budget. I think it was like 94 or 95. So 20 some years, 25 plus years since we balanced the budget. Okay. I know. So both parties, Democrats and Republicans, are responsible for this debt. All right. So they love to point fingers at each other, but the reality is they both overspend. Some more than others, but they both overspend. Okay. Does anybody want to guess, or can maybe you're a history buff and like that, what event in the 20th century started this? Because we actually didn't have a debt until about 100 years ago. Does anybody want to guess what event in the 1900s started this debt? Before World War II. World War I actually did not send us into debt. We were barely in that war. We were in it less than a year. So that one actually didn't send us into debt. What happened between World War I and World War II? 1930s, 1929. It crashed. What big event globally, the worst economic situation we've seen in modern history? Come on, folks. 1929, it started. The Great Depression. Very good, Chris. Yes, the Great Depression. Okay. So the Great Depression is actually what started our debt. The government went into debt. They were so broke because their unemployment was high, businesses shut down. Our two top banks failed because the government didn't bail them out, didn't give them money, a loan to help get through. In 2008, when we had our financial crisis, we had the recession, the government helped bail out the banks. So if the banks had not been bailed out, we very well could have seen another Great Depression. Okay. So the Great Depression, the government went into debt to try to create jobs, to try to, figure out infrastructure. That's when Hoover Dam was built. But who is spending all this money on that? What do you mean on what? You mean the Great Depression? I guess I'm just not clear.
It's just me because like all this money is disappearing and like aren't we like in, how can I say, when the taxes and stuff goes up, it's a word for it, but like who is spending this money to where we're going into Great Depressions and all that type of stuff?
Well, so it's what sends us into depressions or recessions and things like that. It's super complicated. And actually some of the video that the Nearpod we're going to do today will explain it better and stuff because it's quite complicated. But in layman's terms, it's the party gets started, and what happened was people were overspending and getting themselves too far in debt. And the banks were doing the same things. They were taking the money that people put into the bank and they were just loaning it out, so they had no money left. So when people came to withdraw their money, the bank literally didn't have any money. So if I deposited $10,000 in the bank, they lent it out to somebody else to make money. And then I get nervous and I'm like, oh, I need my money back. So I go to the bank to withdraw my money. They literally didn't have it. So this caused the banks to crash during the Great Depression. So since then, the government backs up to 250,000. They say, so that's like when you get a bank account, you want to make sure that you get one that's federally backed, FDIC, and they'll back up to $250,000 because during the Depression, nothing was backed by the government. And the government, there was this model that government and economy were separate. So I would have to take my money. That's what happened. So a lot of people were broke. And then all of a sudden now they had debts. And so they couldn't pay them because businesses couldn't stay open because everybody was in debt. And they thought, oh, it doesn't matter. I can just buy now, pay later, buy now, pay later. really started. Most people didn't have debt prior to the 1920s. Very, very rare. They'd have a small debt. And the 1920s kind of started this idea that we can go into debt and it's okay. And the reality is you want to be really careful. So this is why I might sound like a Debbie Downer sometimes, but I really emphasize this with like student loans. Like, be really reasonable what you're doing, because a lot of people get themselves in over their head. Be really careful when you're buying a car. Make sure you can pay it off in just a couple of years. You know, you don't want to, if you can, get an older car. I know that that's not a fun thing to have, but you know, having a car payment for 5-6 years, that's $600, $700, $800 a month, like that's so confining, you know. So be really careful, because debt is what got us here. And people just think that, you know, we can buy now and we'll pay it later. So the recession kind of did that to us. So the Great Depression got us in debt. And then we were supposed to come out. Then we went right into World War II. And then unfortunately, we kind of set a precedence that we've just never, we've never balanced our budget really. And we're lucky. There's a couple times in the last 100 years that they've balanced the budget. Like I said, last time, it's been over 25 years since they balanced the budget. Okay, just for kicks and giggles, I saw this on Instagram last night, and I'll be honest, it made me think of all of you. All right, and this is not a cheap shot, but this is just funny. This is teacher humor. Okay, so you can have a laugh with me. Okay, so when my students, when I ask them to write an answer in a complete sentence.
On top of that, it's really draining. It's emotionally, physically, and spiritually exhausting. On top of
I laughed. All right. I know, right? Whenever we do the notebooks, what do I get? How many sentences do I have to do a whole paragraph? What? Like, okay. Teacher humor. All right. We got to laugh it. All right. You guys know it's kind of true, right? So, you know it's kind of true. Okay. Let's keep going. Only Chris thinks it's funny. Come on. You know it's true. How many of you are like, yes, I will totally write sentences for you? All right. This is you guys are gonna leave me out on a limb today. All right. That's cool. All right. So what we're going to really focus on is monetary versus fiscal policy. So fiscal policy is when the government spending and taxation influences the economy. Okay, so fiscal policy is when government spending, taxation influences the economy, and it certainly does. When the government cuts spending, it's going to kind of draw back the economy. When the government pumps money into the economy or something like that, or lowers interest rates have a big part of that. What have we seen with the housing market right now, right? What happened to housing interest rates? Loans, they're really high right now. In fact, they're like 7.5 the other day. Like they're really high right now. 2 years ago, they were like 2 point something, you know? So the government's decisions definitely impact the economy. Monetary policy is a set of actions to control a nation's overall money supply and achieve economic growth. Okay, so it's more of the big picture. It's actions that control the overall money supply and achieve economic growth. So it's financial and individual things. So anytime we send aid, let's say to Ukraine, that does hurt our budget. You know, when we send foreign aid, doesn't mean we shouldn't, but then what are we cutting here? What are we not funding here? You know what I mean? So decisions we make abroad definitely impact that. Money that we put into one area, that means there's not money to go into another area. You know, it's expensive. If we're going to start a new program, some kind of social program, something like that, where does the money come from? As you can see, we're already in debt. So it's hard decisions that have to be made. Okay, so let's do our Nearpod and have a little fun with this. I think you guys will, be a little bit more interactive. Okay, so go ahead and easiest way I think to do it is on your phone. You just go to nearpod.com. All right, and then you join. Here, I'll copy the link. You can put it in the chat. But to me, the easiest way to do it is go to nearpod.com and just join a lesson and type in that code. So go to nearpod.com. When you do that, it'll give you this and you just put in the code. All right, and here's the code. Because I'm going to project the video on this screen. All right, and go ahead and join, please. All right, even I will join. F5E, join. Okay. So please go ahead and join. Awesome. I see 4 of you have joined. That's including me, though, so that means 3 of you. So the rest of you, please join. Let's go. Let's go. Let's get a couple more people, please. I've got 13 of you in here, so let's get some more people joining, please. Come on, folks. Please join. You are in class. Please join. Please don't make me complain at you. Come on. All right, awesome. Okay, give me a thumbs up once you've joined. Let's go. Yep, I know sometimes, yeah, the Wi-Fi, that's fine. Thanks for letting me know. Please join. You're in class. You guys don't like teachers to nag at you. I don't like nagging. Do you know what I mean? Awesome. Thank you. Thank you. I appreciate it. All right. Let's work on that fourth quarter, okay? Because I will say, like, it's hard when like I have something planned and then people don't participate. Then what position do you put me in? Do you know what I'm saying? Like, it's not fair. You know what I mean? Like, this is part of the arrangement, you know, like I get stuff thing, but you guys just have to join once in a while. So, and stuff. And it is frustrating on my end when I don't get participation, right? When it's like, come on, you know, and stuff. So, but then you guys get mad if we nag. So you kind of see that it's a two-way street here a little bit. Okay, let's get started. All right. So this video is going to do a good job. We won't do the free response, but we'll do the select response. Okay. So some of them I will skip, except that they do a good job of kind of explaining how the government impacts our economy, how they help stabilize the economy when we get into a rough spot, or they also got to keep us from going a little bit too high on things to make sure that we create kind of a stability somewhere in the middle, not too left, not too right, somewhere in the middle.
Welcome to Crash Course Economics. I'm Jacob Clifford.
I'm Adrienne Hill, and today we're talking about monetary policy.
So each year, Time Magazine comes out with a list of the world's 100 most influential people.
It includes heads of state, religious leaders, entrepreneurs, artists and activists, singers and actors, the most famous and infamous. There's one person on that list, someone who is arguably the most influential person on earth, that most people don't know. Their decisions, good or bad, likely impact billions of people. Janet Yellen.
She steers the largest economy in the world. Janet Yellen is a big deal, and she's a big deal because of monetary policy.
Okay, don't worry about this one. We'll keep going.
The Federal Reserve is the central bank of the United States, and it's commonly called the Fed. Europe has the European Central Bank, or ECB, and other countries have institutions that play similar roles. Most central banks have two important jobs. First, they regulate and oversee the nation's commercial banks by making sure the banks have enough money in their reserve to avoid bank runs. Their second job, and the job we're going to focus on today, is to conduct monetary policy, which is increasing or decreasing the money supply to speed up or slow down the overall economy. Monetary policy is what makes the Fed and the Fed chair so influential.
Let's start with interest rates. An interest rate is the price of borrowing money. When banks lend money, they expect to be repaid the amount they lent, which is called the principal, and a percentage of the principal to cover inflation and to make some profit. That percentage is called the interest rate. The number of car loans, student loans, home loans, and business loans that get made depends on interest rates. When interest rates are low, borrowers will find it easier to pay back loans, so they'll borrow more money and spend more. When interest rates are high, borrowers will borrow less and therefore spend less. In the US, the Fed doesn't have the power to tell banks what interest rate to charge customers. So instead, the Fed manipulates interest rates by changing the money supply. If the Fed increases the money supply, there'll be plenty of money for banks to loan out. Borrowers will shop around for the best deal on a loan, and banks will be forced to lower interest rates because they're going to have to compete or else no one's going to borrow from them. A decrease in money supply has the opposite effect. Less money supply means that banks have less money to loan out, so they're going to try to get the highest interest rate possible. So less money, higher interest rates. If the central bank wants to speed up the economy, they can increase the money supply, which will decrease interest rates and lead to more borrowing and spending. That's called expansionary monetary policy. If the central bank wants to slow down the economy, they decrease the money supply, less money available will increase interest rates and decrease spending. That's called contractionary monetary policy.
Okay, so there's two different types of policies. There's Contractionary and expansionary, okay? So which policy is used to increase the money supply and reduce interest rates? So she said these really quick at the end and he kind of jumped in and stuff. So which one and stuff is used to stimulate the economy or boost the economy? All right, so pick A, B, or C. Okay, I think it's becoming pretty clear which one is right. And that's expansionary, right? So expansionary policy is where you increase the money supply and reduce interest rates. So when interest rates are low, money supply is high, the economy will boom, okay? And it will go. So we saw this during part of the pandemic, right? They pumped more money into the economy and interest rates were low to get people to spend because they didn't want us to fall into a depression during the beginning of the pandemic. So it was kind of unstable. We weren't really sure what was happening. But what we're seeing is we're seeing a shift right now, right? Because prices got too high. What happens when you do that is then it causes the price to go up. So the housing market's a great example of that, right? Prices went up so much in just a couple of years that the federal government's like, we got to slow this down. We have to slow down the spending. Okay. We have to bring down prices. So the way they're going to do that is they're going to pull some money out of the economy, raise interest rates. That, like I said, is going to, when you raise interest rates, it discourages spending. And you want to discourage spending to help bring the inflation, aka the price of goods, down. And remember, we've been talking about how the price of goods and everything, housing, cars, food has gone out of control. So they're trying, we're at a 40-year high right now. So they're trying to bring that down. So sometimes they pump into the economy to stimulate things. And then sometimes they have to pull the reins because it's getting out of control. And what we've seen is that in 2021, 2022, things got a little out of control. All right, let's keep going.
Here are some real-life examples. After the dot-com bust and then 9/11, the U.S. economy was in a slump or a recessionary gap. Output was low and unemployment was high. To speed up the economy, the Fed boosted the money supply, which lowered interest rates. This made borrowing easier, which increased spending, and as a result, the economy began growing again, albeit slowly. Here's another example. In the late 1970s, prices were rising up to 13% per year. Inflation is usually more like 2 to 4%. The Fed chairman, Paul Volcker, decreased the money supply, causing interest rates to shoot up. People bought fewer homes and cars, and businesses invested less. Contractionary monetary policy drove down inflation, but with the downside of increasing unemployment. There are just no easy answers here. Sorry. During the Great Depression, though, the Fed blew it. 73 years later, Fed Chairman Ben Bernanke admitted, "We did it. We're very sorry. We won't do it again." So what did the Fed do wrong? Well, there are two things that keep the banking system healthy: confidence and liquidity. When customers deposit money in a bank, they need to feel confident they're going to get their money back. In the early years of the Great Depression, the Fed allowed several large banks to fail, which caused widespread panic and bank runs in other banks. The result was a third of all banks collapsed. The banks failed because they didn't have liquid assets, which is a fancy pants way of saying the banks had stocks, bonds, mortgages, but not cash money. So when depositors rushed to take money out, the banks couldn't pay. The Fed gets blamed for prolonging the Depression because it didn't give banks emergency loans, which would have increased the liquidity in banks and the money supply in general.
Okay, so which of the following is a result of contractionary monetary policy? Okay, so contractionary monetary policy. All right, so loans are easier to secure and pay back. The money supply increases, or risk of high unemployment rises. All right, so is it A, B, C? Which one is it? All right, good. So keep answering. It looks like a lot of you are getting it. So contractionary is when basically the government pulls the reins. So they raise interest rates, they pull money out. And when that happens, businesses, the economy slows down. When the economy slows down, you do see cutting of jobs. So that could lead to a rise of high unemployment rates, okay? And unfortunately, this is one of the negative things about rebalancing the economy. When the economy is booming, businesses are expanding, then there's lots of jobs. When things get overinflated, though, prices are too high and we have to bring the reins back more to reality. So the government will raise interest rates, which discourages people from spending, so it brings down prices. So like, for example, right now in the housing market, with the rise of interest rates, less people are buying. So what's happening to property prices? They're coming down. But that also means less realtors are making money, right? There's less transactions. We've seen some businesses laying off. Twitter laid off, Google's laid off, Amazon's laid off. Like some of the big companies a bunch of companies have laid off because the economy is slowing. So it's one of the hard parts of when that happens. Okay, let's keep going.
General. But how does a central bank change the money supply? In the US, there are three main ways. Let's go to the thought bubble.
When you deposit money in a bank, the bank holds a portion of deposits and loans the rest out. This is called fractional reserve banking. The fraction of deposits the banks are required to hold in reserves is conveniently called the reserve requirement. The first way the Fed can change the money supply is by changing that requirement. Decreasing the reserve requirement will increase the money supply, and increasing the reserve requirement decreases the money supply. The Fed is the banker's bank, so if a commercial bank needs money, they can borrow from it. The second thing the Fed can do to change the money supply is to change the interest rate that it charges banks. That interest rate is called the discount rate. Decreasing the discount rate will make it easier for banks to borrow, and that'll increase the money supply. Increasing that rate will decrease the money supply. The third way to change the money supply is difficult because it requires Janet Yellen to get approval from the Illuminati, the secret cabal that runs the world. Nah, I'm just kidding. The third method is called open market operations. This is when the Federal Reserve buys or sells short-term government bonds. Now, a government bond, or something called a treasury bill, is an IOU issued by the government that says, I'll pay you back later. Banks hold those bonds because they earn interest and are generally less risky than stocks. If the Fed buys these previously issued government bonds from a bank, it increases that bank's liquidity and increases the money supply. If the Fed issues more bonds, the banks will have less liquidity and less money to loan out, and that'll decrease the money supply. And in the US, deciding how many bonds to buy and sell is done by the Federal Open Market Committee.
Thanks, Thought Bubble. With these options at its disposal, the Fed can increase or decrease the money supply pretty darn quick. The option they use most often is open market operations.
Okay. So which of the following is a way for the Federal Reserve can increase the money supply? All right. They can increase the reserve required by the banks. Governments buy bonds from the banks, or increase the discount rate for banks. What do you think? What do we think? So keep answering. Let's go. Participate. So what is a way that the Federal Reserve, that would be the national bank, can increase money supply? Well, it's B, right? And stuff. Hey, Raven. So they buy government bonds. So when they buy government bonds, it gives money to the banks, which means the banks then have more money to lend out. Okay, so if that makes sense. So buying these bonds, then in exchange, they give money to the banks, and then the banks have more money to lend out in car loans or home loans or other types of interest loans, okay, which stimulates the economy. All right, great. Let's keep going.
During the 2008 financial crisis, when the economy was in severe recession, the Fed went straight to work buying massive amounts of bonds, boosting the money supply and dropping interest rates to practically zero. But it wasn't enough. The economy was still in bad shape, so the Fed did something very uncommon in the history of central banks. It increased its monetary stimulus through something called quantitative easing. We call it QE at work because QE rolls off the tongue more easily than quantitative easing. Plus, who knows how to spell quantitative? Basically, it's when central banks buy up longer-term assets from banks. So not only was the Fed buying regular treasury bills, it was also buying things like home loans, aka mortgage-backed securities. They did all this with made-up money. This QE has raised worries about massive inflation. When you add a lot of made-up money to the economy, prices can rise. Milton Friedman observed, inflation is always and everywhere, a monetary phenomenon. So if the Fed has been increasing the money supply steadily since 2008, why has the actual inflation rate stayed so low? Of course, as always, the answer is complicated. Many economists say it's because banks haven't loaned out the money. Remember, banks have to hold about 10% of their deposits in reserve. The other 90% is called excess reserves. Pretty straightforward, which is basically the amount that banks are free to loan out. Under normal conditions, banks would prefer not to hold a lot of excess reserves because holding money doesn't make money. But since 2008, excess reserves skyrocketed. This means that banks held the money and it never really got into the system. Why? Some say say it's the stricter lending regulations, but also borrowing a bunch of money for a house seemed a lot scarier. Others suggest that low inflation in the US is the result of uncertainty in Europe, and that's caused foreigners to hold dollars. Some argue that it's because the economy is still sputtering. One thing's for sure, as the economy continues to pick up speed, we'll see the Fed clamping down on the money supply to increase interest rates. After all, it's the Fed's job to take away the punch bowl just as the party's getting started.
Okay, don't worry about answering this. We will keep going. Okay.
So now we've talked about the two main ways economists speed up or slow down the economy. Fiscal policy, which is changing government spending or taxes, and now monetary policy, which is changing the money supply. In an ideal world, the economy would always be perfect and we wouldn't need these tools. But the world isn't perfect, so sometimes intervention is necessary. So which one is better? Well, like any clear, unambiguous question in economics, the answer is, it depends. It depends on the severity of the slump. Many economists argue that for your garden variety fluctuations, monetary policy is more effective. It's usually enacted quickly by experts whose only job is to focus on the state of the economy. But in a very severe downturn, fiscal policy might become much more effective. In 2008, the United States did both. It also depends on whether your country's central bank is tangled up in politics. The US and many other developed nations have worked hard to isolate their central banks from politicians who might be short-sighted. The result is that monetary policy generally works and doesn't have a lot of side effects.
So the next time you see Janet Yellen in a magazine listed as one of the most influential people, you can shout, "Hey, I know who that is and I know what she does." The people in your dentist's office might freak out, but maybe not.
Maybe they watch Crash Course Economics.
Thanks for watching. We'll see you next week.
Okay, so what's good about this activity and stuff is just understanding that the government and the economy are very much connected. And so we're going to spend time in the course arc and the notebook that a lot of the time the government influence on the economy is through monetary policy. Okay, so actions made through decisions in the budget, decisions on policies, through Congress. But fiscal policy, when they increase spending or decrease spending, when they increase taxation or decrease taxation, it's a more extreme version when the economy is maybe overinflated or underinflated. So they're trying to stimulate or they're trying to pull back pricing. Then often fiscal policy will be the bigger intervention. Okay, so let's go ahead and let's jump into module 9, lesson 5. We're going to open up the course arc and the notebook. All right, and then get through. My goal is 1 through 4 today. All right, so go into our course. And we're going to go to modules 9.5. And you're going to go to notebook and click on open. Is it locked? All right, let me go in just a second. Oh, it's opening Friday. I'm going to have to go in and open all these real quick. Okay, just a second. Okay, refresh and now try opening it. It should open. Did it work? Is the course arc opening for you? Try refreshing. Okay, awesome. Sorry about that. I will go through and make sure I open that in the other classes before we do it today. Okay, so get your notebook open. Once your notebook is open, you're going to rename it, save it to your Google Drive, and make it shareable. And remember, that's anyone with the link. Anyone with the link. And then also get your course arc open. Okay. Go ahead and give me a thumbs up once you have the course arc open and your notebook open. You're ready to go. Awesome. Sorry about that delay with the course arc. If it's not opening for you, try reloading because I did just change the date. It can open, so it should open now. Okay. All right. Awesome, awesome. So we're going to jump into the course arc. Okay, the overview page had our standards and what we're going to be, so understanding how the federal budget is created, analyze expansionary and contradiction or fiscal policy, which we talked a little bit about in the video. We'll talk a little bit more about it tomorrow also. Okay, and then limits on fiscal policy. So let's go to the introduction page and we're going to get our essential question. What is the key question we're focusing on? All right, and that is, what is the proper role of government in the economy? How much or to what extent should the government be involved in the economy? So we're going to copy and paste and put that in number 1. I'll put this in the chat for you. What is the proper role of government in the economy? And this also then is where you get into debate. I think everyone agrees to an extent we need government involvement. We need government to help, set minimum wage, 40-hour work week, kind of parameters for businesses. Sometimes when the economy really gets in trouble, we need help fixing that, because we don't want to go too far into a hole or too overinflated. So trying to create kind of a medium, which it's a constant back and forth. Just when you think you have it stabilized, it'll go down or it'll go up. So it's an ever-changing thing. But what will politically cause division then is to what extent? To what extent? Because sometimes the government does get too involved, too controlling, and sometimes maybe not enough. So there's instances to support both. Our national debt is maybe one example of being too overly involved. We spend more money and that number just keeps going. And at what point is that going to get us in trouble? So the question is constantly, to what extent? What is the proper role? And I can't answer that. I have my personal opinions, but that is then where it's debatable, right? People's opinions, what they feel. How much do you think the government should do for us? How much should they not do? How much should they intervene? How much should they not? Everyone will agree to an extent the government should, but how much is then the debatable part. How much is where you'll often see, differing opinions. Okay, let's go to the vocab. So there's 5 key terms. Okay, there's fiscal policy. So this is the U.S. government spending revenue collection. Fiscal year, which is it's a 12-month year of budgeting, or 12-month period of budgeting. So January to January. Okay, federal budget. So this is a written document that estimates what the government brings in and what they're authorizing to spending, and also how much then more debt we will incur. And as you saw last time, right, we pay about 9% of our income toward the debt, toward interest, just interest, not even actually paying down the loan, just the interest on our loans. Because we owe money. A lot of that money, anybody want to guess what country we owe a lot of our money to? And it's somebody we actually don't get along with. Give me a C. Give me an H. China. Yeah, they actually hold a lot of our debt. So, and other countries, they're not the only country we're in debt to, but a lot of it is to China. All right. So interesting, huh? Because we actually have a pretty rough relationship with China. A fiscal policy used to encourage economic growth, often through increased spending or tax cuts. So this is expansionary policy. So when you try to stimulate the economy, when we get into recession, a Great Depression, when things are really struggling, then you cut taxes so people have more money. You increase loans. You bring down interest rates so it's easier to get loans. This stimulates the economy. Contractionary policy is the opposite. And we're seeing contractionary policy right now, okay, because we got overstimulated. Prices went so high. So now we're trying to bring it down. So how do they do that? They decrease spending. They higher taxes and higher interest rates, which discourage people. So if I'm paying more in taxes, it's less for me to spend. If I pay more in interest, then I'm less likely to go buy a new house or buy a new car or something because the interest rates are higher. So it discourages spending. All right, let's do the matching. All right, so a fiscal policy used to reduce economic growth, often through decreased spending, that is contradictory policy, okay? So think decrease, okay, reduce growth, bring things down. We're going through that right now. Contradictory policy, okay? The use of government spending and revenue collection to influence the economy. All right, so that's going to be fiscal policy. All right. A fiscal policy used to encourage economic growth through increased spending. So think opposite. So expansionary. So contradictory is to decrease. Expansionary is to increase. All right. It's the same idea, just one increases, one decreases. So one is pumping more money, lower interest rates, encouraging people to spend. The other is higher interest rates, decreased spending, higher taxes, anything I can do to discourage spending. And that's what we're going through right now to try to bring the economy back into, because inflation's so high. A 12-year period of spending, that is the fiscal year. and then the written document that lays out how much we're spending, how much we're in debt, where the money's going. That is the federal budget. So go ahead and make sure that you get that recorded, and then let's go into our course arc, or into the notebook. Okay, so first is fiscal policy. And that is the use of government spending expansionary policy. These are the things we do to stimulate the economy. So lower interest rates, more loans, trying to get things. So we saw this done at the beginning of, that's why, like, think about, we got those stimulus, we got, I think 2 or 3, right, from the government if you made under a certain amount of money. And that was to encourage people to go out and spend during the beginning of the COVID pandemic, right? So think those stimulus. So they also gave out stimulus in 08, trying to, again, get people to get out there and spend. Go spend money. Try to, because think, when you spent money. So example, one of the stimulus I got, I used it to put a pergola on the back of my backyard to create more shade. So I spent money that I got and I gave it to a business that helps that business. So it encourages people to spend. Okay. All right, next is federal budget. So this is the written on paper document that shows what the government is going to spend. It has to be approved every year. So contractionary policy, that's what we're going through right now, okay? Where you increase interest rates, you pull money out of the economy, you make it harder to get a loan. You're basically trying to discourage spending to bring the economy back into check. And that's what's happening right now. And like the housing market is a great example of that. By increasing interest rates, people, it's harder, 1, to qualify, and 2, people don't want that high payment, so they're less likely to buy a house. So now that there is less people buying, that creates competition. It brings down the prices of homes. So if you look at the last 12, last 6 months in particular, you've seen prices slowly decrease. Okay, fiscal year, that's that 12-month period of the budgeting process. Okay, give me a thumbs up once you have all the vocab in, and then we'll keep going. Give me a thumbs up once you have all your vocab in. And then we'll keep going. So we're going to go back into the course arc, okay? And we're going to click on, so that we were on lesson vocabulary, we're going to go to the federal budget and fiscal policy, all right? So fiscal policy is a term used to describe the spending and revenue collection that influences the economy. So it's what the government does, what money they spend, and what taxes they collect that influence the economy. So it's a tool used to either expand, stimulate the economy. So like I said, beginning of the pandemic, we saw a lot of stimulation, giving out money to people to try to encourage them to cover their bills, but also to go out and buy, okay? But then also it can be done to slow down the economy. So for example, we're going through that right now, increasing interest rates, making it harder to get loans so that we discourage spending and try to correct some of the overinflation that's happened. They also are responsible for setting the federal budget. So the federal budget is the written document estimating how much the government brings in, so like in taxes, and then also authorizing their spending, and it also authorizes the debt that they go into every year. Okay, so let's check for understanding. Based on the data, which category is most likely responsible for the steep growth in spending? All right, so if we look at this graph right here, 9.1, all right, which area is most? So is it federal spending, human resources? Is it defense? Is it net interest? Is it physical resources, or other? Which one do we see the most responsible for the increase in spending? And this is based on billions. So what do we think? Somebody in the chat, what do we think? Oh, come on, folks. Yes, human resources. Very good. Thank you. Thank you, Caitlin. All right. So it's human resources, right? Human resources. And we see that right there. Federal spending, human resources. So Social Security, Medicare. So remember, those are those programs I talked about that we put tax money into, but it's costing us more and more money to keep those programs going because we have more and more of the population retiring. Baby boomers make up a huge portion of the population. So as more and more people retire, then that costs us more and more money. So more spending goes into those programs to support them. All right, so let's look at number 3. And it says, read the section fiscal policy, explain how you think fiscal policy works to expand and slow the economy. All right. So the federal government is not interested in making income meet expenses. Okay, so they're not interested in basically balancing the budget. Otherwise, they would. They haven't balanced the budget in 25 years. So the government uses taxes and spending to speed up growth or even to slow it down. Here, let me put some of this in here. Okay, so for example, on average, our government spends it on average 10 billion with a B dollars a day, and it has a huge impact on supply and demand. When the government increases spending, okay, this is expansionary policy. When they decrease spending, this is contradictionary policies, like we're talking about. So they make actions that stimulate the economy or slow down the economy. So like right now, we are seeing contractionary policy. Okay, they're trying to slow down the economic activity to bring prices down, to correct inflation. But 3 years ago, beginning of the pandemic, we saw expansionary policy, tax credits, tax cuts, stimulus money, all these things to give us more money. When they cut taxes, that means I have more money to spend. When I get more tax deductions, that means I don't owe as much in taxes. That gives me more money to go spend. When they give out stimulus money, then that is money that we can use to go spend. It's extra money, right? So it's expansionary. So there's actions on both sides. Okay, so if we keep going down, all right, there are 4 steps to the fiscal year. So every fiscal year, the government has to set a budget, and there are 4 steps to setting that budget. Okay, so first, agencies. So all the different independent agencies. So think of all the different cabinet members. Remember, there's over 15 different cabinet members that serve under the president. All these different agencies have to submit their budget. Here's what we need. Here's our operating costs. They have to justify why they need the money that they need from the government to be funded. Okay. When they do that, then it is submitted to the president, the executive branch, and the president draws up the official budget, takes all the different cabinet members, all of their budgets, puts them together, maybe makes some adjustments with them, and then that has to be submitted to Congress. And remember, we talked about when we did the 3 branches of government, Congress is the one that is responsible for setting the budget. So the president, through the cabinet members, the executive branch proposes the budget, but it's the actual Congress, the House and the Senate, that approve the budget so that the president can't just go crazy cutting money or spending more than we have. So it creates kind of a checks and balance that the president doesn't just get basically a free check, and I can do whatever I want. So it creates some accountability. It also forces compromise, right, between Democrats and Republicans, depending who is in what office. Okay, so to try to moderate one group from overspending or underspending, depending on their agenda. Once Congress approves a budget, so they vote on it, they approve it, stamp and seal, this is what you can spend, here's what we can do, here's what each department gets, then it goes back to the White House. And just like a law, the president then signs it into law. Now, if he doesn't agree with it, he'll send it back to Congress, and they maybe sometimes have to debate, but most of the time, if things go smoothly, Congress will approve something after some adjustments. It gets sent to the president, and then the president signs it, and then we have an official budget so that the money can be released by the reserve. Otherwise, that money can't be released till it's passed. All right, so let's do number 4 really quick, and then we'll wrap up class. So the federal budget fiscal policy, read the section, says using your own words, explain why you think the federal budget reflects national priorities. So it is the discretionary spending that really represents our national priorities, okay? And the reason that we see this, so how much money do we put into defense spending? How much money do we put into social programs? How much money do we put into education? How much do we put, that shows a reflection of what we think is most important. Uh-oh, did it cut off at around? Oh, around the world. Okay, here we go. Here's the rest of it. So what's really important is basically spending represents what politicians are doing. Elected officials are motivated to get reelected. So oftentimes they will approve or disapprove of things in the budget based on what they think their constituents, aka the voters, would like or wouldn't like. Unfortunately, that doesn't always mean it's what's best for the country. Sometimes we have to cut spending. We just don't have the money. Sometimes we need to stimulate that. And people don't always think about it from a big picture perspective. They often think about it just from, well, if I do this, my people aren't going to like that. They won't vote for me. So unfortunately, elected officials don't always make decisions of what's best for the country. They do things what's best for just their voters or what their voters would like or not like. So we see that a lot. Okay, so we're going to stop there. All right. And then tomorrow, we will keep going. All right. We will keep going and work on more of the course arc and the notebook. Okay. So we talked a little bit about monetary versus fiscal policy, did an AirPod. We got about half of the course arc done. Tomorrow we will work on the notebook, course arc, and I'll give you a review sheet. Nothing is due this Friday and stuff. This isn't technically due till the Tuesday after we come back. But if you want to work ahead and get this done, you are able to do that. All right. And I'll go in today and make sure that I open everything up from the 6th. It looks like I set them for the 10th. So I'll make sure that I get that fixed today. Okay. So I hope you have a great day. I will see you tomorrow and we will continue talking about monetary and fiscal policy. All right. How the government influences the economy, how they can stimulate the economy or how they can try to correct the economy through kind of different policies. All right. Have a great day. Thank you. You're free to go. Thank you.